I've decided to share something very different with you guys on YouTube, mainly talk about my own investment strategy in my portfolio, how I structure my portfolio, how I find certain stocks, what kind of portfolio allocation do I have, how do I structure, manage a portfolio, what kind of investment principles do I believe in. But it's gonna be something very different. It's gonna be one of the most in-depth videos that I've done. And this is the strategies that I mainly use to make over 33% in 2024, 28% in 2023, and 27% in 2022. And I've shared year-to-date returns with you guys on YouTube. I've shared screenshots of people that have been in my own Discord, and I got the same exact results following the things that I do. I'm gonna share it all with you on YouTube. And this is something I've never done before. And I'm sure it's not gonna get as many views I would get if I was talking about Apple, Tesla, or Nvidia. But if you do enjoy these kind of videos, if you do find it helpful, all I ask, if you could please press the like button and maybe consider subscribing. The more subscribers I have, the more I could do tutorial videos and try to, teach you guys something that I've learned the hard way, or maybe just talk about my own strategy in general instead of just keep talking about random stocks. Okay, now before I get into my own strategy and how I structure and how I find certain stocks with some examples of stocks that I own and why I own them and how I found them, I'm gonna have to discuss 2 points for the introduction. The first point is mainly the whole thing around growth investing and value investing. I think the biggest investing mistake people make is they always belong to a certain camp. Meaning they say, oh, I'm a growth investor. I will never invest in these value trap companies that are not growing, trading at 5 times earnings. I will never invest in them. If they don't have an exciting story, I will not buy them. But you have a lot of people that are only value investors. They say, oh, I'm not going to touch these growth unprofitable junk companies. I will never do that. I hate Cassie Wood. I hate all growth investors. I'm never going to touch a growing company. I only invest in stocks at 10 times earnings or below, or 15 times earnings or below. Anything above 20 times earnings is overvalued. And anything that's unprofitable, I will never touch it. And there's nothing wrong with that. I mean, people like to do that stuff, and there's nothing wrong. But I do something very different. And I don't label myself as a growth investor or value investor. I don't label myself as a Tesla investor or an Nvidia investor. I don't defend a certain stock or a certain group or follow a certain narrative. My main goal in the market is to make money. I don't care if it's with growth stocks. I don't care if it's with value stocks. I don't care if it's even with cryptocurrency, although I don't own any crypto. But if you could convince me about some crypto, I would be open to buy it, because my main goal in the market is to make money and not to follow the narrative. And this is a big point that a lot of people miss. And this is something really big on YouTube. And I hope one day to be able to change that if my channel gets big enough. Because, for example, you have a lot of channels that have been bearish since 2022 till today, and they still have more followers than ever, more viewers than ever. They have more engagements than ever, because people are still following the narrative, following what makes them feel better and not what actually makes them money. And I hope to be able to change it someday and get people a little bit more open-minded about certain things. But in the stock market, we have cycles. In certain cycles, growth stocks outperform value stocks. And in other cycles, value stocks outperform growth stocks. For example, since 2015, growth investors have absolutely destroyed value investors. People that invest in unprofitable companies, junk companies, speculative investments, they made more money than ever, while a lot of value investors have struggled. Now, there's 2 things we can do. We can hate on the growth investors, call them name, and just hate on them. Or we could maybe try to follow along. We could maybe be open to finding some kind of a growth stock that's close to profitability, or that's profitable, but it's growing revenues rapidly and has a lot of cash on the balance sheet, maybe to cover some losses or to do certain things. Maybe we can find these stocks if we're open-minded enough and we're not following narratives, but we're trying to follow how we could make money in the stock market. So this is why I don't label myself as a growth or value investor. Sometimes growth stocks outperform and I bought growth stocks. Sometimes value stocks outperform, and I do buy value stocks. I'm open to both of them. The second one is, this is something Michael Burry said. He said, if you are going to be a great investor, you have to fit the style of who you are. So a lot of people try to follow Warren Buffett. And maybe Warren Buffett is built in a certain way. He's extremely patient. He likes to read annual reports, sit hours and hours every day. And you could try to be like that. But if you're more of an active person, it's going to be very hard for you to do. So maybe trading is something that's better for this person, or maybe something else. But it's just something you have to fit the style of who you are. So you could try to be like someone else that's more successful, and it might work out. Maybe this is just not your personality and you have to do your own thing. And there's nothing wrong with that. And you're going to find out in my strategies that I'm not following Warren Warren Buffett, and I'm not following Cassie Wood, and I'm not following Michael Burry. I'm just doing my own thing. Whatever works for me. I tried everything. I tried dividend investing. I've tried everything. And it took me years to figure out my style. And I'm going to share it with you guys here in the video. Now, the main way I structure my portfolio, and I'm going to start with the big one, going to the small one. The big one is the long-term investments. Now, the long-term investments make up to normally around 60% of my portfolio. And these are stocks that I believe could return a minimum of 15% annual over the very long term. Nothing less than 15%. Because the S&P returns 7 to 8% on average over the long term, maybe 10%. If I'm putting in all the work to find this investment, research the stock, do all these things, I want to at least find some kind of a stocks that could return like 50 or 100% higher than the S&P 500. So I look for a minimum of 15%. Now, some of these stocks end up returning 20, 22%. But for the minimum, absolute minimum, I look for a 15% with larger, mid to large cap, safe companies, compounders, stocks that have great charts, that keep on going up, they just keep on going. And the stocks that I own that fits this example, it is a stock called AutoZone. They just sell auto parts in the United States, in Brazil, and Mexico, a few other countries. They're trying to expand. They just sell auto parts. Very boring business model. But over the past year, AutoZone is up 33%. Over the last 5 years, this boring company is up 224%, and the max AutoZone is up over 44,000%. One of the best investments of all time. And this is an example of a boring stock that's a recession-proof. This is key. It has to be a recession-resistant stock because you don't want anything to get in front of the compounding. You want the 15% if we have a recession or if we don't have a recession. If the Fed hikes rates or if the Fed cuts rates. If we have a strong dollar or if we have a weak dollar or whatever happens. You always want the 15%. So you have to try to stick with companies that are more recession resistant, that could do okay in recessions and could do okay in growing environments and could just do well all around. And AutoZone is a beast. And my cost basis, I bought it around 2,300, then I averaged to 2,200. Now it's sitting at 3,200. Now my thesis with AutoZone is very simple. Now it's sitting around 20 times earnings. I bought it around the mean, around 16, low 16 times earnings. And this is just a basic example of how I find these stocks. I look for companies trading below the average. And then I look at margins. I make sure that margins are higher or the same as the average. And I just make sure that everything is the same. Now, sometimes you have some fear situations. They missed on earnings, or AI stocks are favored, and these safe stocks, they go out of fashion. You could buy them. This is how I bought AutoZone. I bought it in 2023 whenever everything was rallying, but people did not want AutoZone. This is when I bought the stock, and I'm up, I think, like 38%, 39%, something like that, which is pretty good. Now, sitting at 20 times earnings. Now, if you could buy AutoZone, let's say around 16 times earnings, which is around the mean multiple, you have the chance of a potential multiple expansion. And if you look at EPS or earnings per share growth for AutoZone, it's been all over the place, but they grew every single year. Even in 2020, they were able to grow 13.5%. But earnings per share growth has been on average around 15%. So if we're paying close to the mean multiple and AutoZone grows earnings per share 15% a year, that means we will most likely get this 15% annual return. But we could be a little bit higher because if we have a multiple expansion like we had recently from 16.5 pretty close to 20 times, then your return could be much, much higher than 15%. In my case, it wasn't 15%. It was pretty close to 38% in my first year of owning AutoZone. So this is a basic way to look at it. Try to find stocks close to the mean, growing 15% plus, earnings per share that are sustainable, could do well in recessions. This is what the stocks that I own have in terms of the 60%, which are the long-term investment. Now I have the 20%. So 20% is something I call turnarounds. Turnarounds are stocks. I talked about GEO. I talked about Pfizer. I talked about Bristol Myers on YouTube. I've talked about different kind of stocks, Sandstorm Gold, which I'm going to get into a little bit. Now, these stocks, or you could, for example, look at Warner Brothers Discovery. You could look at Paramount. You could look at Boeing. You could look at American Airlines. You could look at all these stocks that have a special situation. These are stocks I call a turnaround. Now, these turnaround stocks, they have extremely bad sentiment, a very ugly chart. No one wants to touch them. And because there's such bad sentiment, a lot of the bad is already priced in the price. So even if they miss on earnings, sometimes these stocks could move 20% if they missed on earnings, because expectations are just so low in terms of the sentiment on the price. And once the sentiment is so low and people are giving up on the stock, you could buy it. It's like buying $1 for 50 cents. You buy it on bad sentiment. Something good happens. Maybe, new management comes in. Maybe they beat 1 or 2 earnings reports. Maybe they sell some assets and pay some of the debt, save on interest expense. Now, if these things happen, the sentiment could go from extremely bearish to even a little bit bullish. It could cause 50 to 100% moves in the price within 2, 3, 4, 5, 6 months. I've made 50 and 60% on stocks in 2 to 3 months just buying turnarounds on very bad sentiment. And I think Pfizer and Bristol Myers fit the category right now. This is a stock I talked about not just on YouTube, but even on Twitter. And I do share a lot of these things with you guys on YouTube and Twitter. Most of the stuff, I share them in my own group, of course. The link is in the description, but I share as much as I can with you guys on Twitter. And this is something I posted in June of 2023. And I don't post these things very often. And I said, GO is a bargain here. It was just $7.07. Now the stock is sitting at $14.06. My cost basis is $7.10. I'm up more than 100, pretty close to 100% on the stock within was it 11 months or 12 months, 100%, because the sentiment was so bad and GO kept going up. I could give you another example. If you look at ANF, this is a stock that a lot of people talk about. ANF, it went skyrocketed. This is just an apparel company, but the sentiment was so bad on ANF that it made such a massive, massive move. And this is what I call turnaround plays. And I put in 20% of my portfolio in them. Normally they have a minimum of a 2x potential, but some of them like Pfizer, I think if the sentiment changes on Pfizer and things started going the right way, I see 20, 30, 40% on Pfizer within 2, 3, 4 months. Now, it might not happen. It might take a year or two, but I'm still going to get this kind of return. Now, what I do is I buy them for the short term, and then I sell them for a profit, and I just move on to another turnaround play. The reason I don't keep them for the long term is because they are not growing at a rapid pace. I like to keep companies that are growing at a rapid pace for the very long term. If it's a company like GO, it's not going to keep growing earnings per share. It's more of a declining industry, bad sentiment. I would sell it. Same thing with Pfizer. Pfizer is a horrible long-term investment. This is just the way it is. Look at the pharmaceutical chart over the last 10 or 15 years. Same thing with banks. All these things are turnarounds. You buy them in the short term, $1 for 50 cents. You sell it at $1, 10 cents, you move on. And this is how I do it with these stocks. And I've shared another one, Sandstorm Gold. It hasn't been the best, but it's up 20% over the last month. And I've shared it on YouTube when it was like $4.80, I think. Now it's $5.03. Sandstorm Gold is up 20% in a month. And I think it could easily be $8 or $9 within a few months if everything goes right with the current price of gold of pretty close to 2,300. This company is extremely undervalued. And once the sentiment starts to change, I could see over 100% even more than the 20% on Sandstorm within 5 to 6 months. And maybe you're making fun of me right now, but if gold does hold up, you will see how powerful the change in sentiment is. And this is what I look for in these turnaround plays. Now, the 10% is mainly in microcap stocks. I've shared some of them with you guys on YouTube, and I'm going to try to share them as often as I can. Some of them are too small to share, but microcap stocks, companies trading below $600 million market cap, profitable, insider ownership, normally have a 10x plus potential over the next 10 years, 8 years, 15 years. I've shared one of them called Mama's Creations. They make meatballs. The stock is up 183%. And I shared it on YouTube when it was $3. My cost basis is $1.74. I'm up 200% in this investment. And I normally own 5, 6, 7, or 8 of them. And I try to share them on YouTube, but they're pretty easy to find. You could find them on Ticker. Go to Ticker, you go on the screener, and you just go on the screener and you try to put in companies below 600 million, growing earnings per share 15% or 20%, look for insider ownership. I'm sure you'll find a few of them. They're very easy to find. But in terms of these stocks, the key is to own as many of them as you can because you want them to be diversified. This is in a book called 100 Baggers or 100 to 1 in the market. I'm sure you've read it. And this mainly talks about being diversified within microcaps. Let's say you own 6 microcaps, 5 of them go to 0. But one of them goes up 100 times or 100 bagger. This is all you need. This is going to set you up for life. But the likelihood of 5 out of 6 going to 0 is very unlikely. But likelihood is very high for them to go up 10, 20, 30, 40 times. And you could do amazingly well with being diversified under 10% of the portfolio. So this is what I try to look for. Now, another thing that I do, 9% of the portfolio is more in cash and short-term options and shorter-term investment. short-term investments. Sometimes I try to short the S&P, I buy put options. Sometimes like on Sandstorm, when Sandstorm went down a lot, I sold $4 puts. The $4 puts gave me around a 14% annual return, meaning I sold the Sandstorm puts at $4 and I could make 14% yield on them if I just sit and do nothing. But worst case scenario, I own Sandstorm at $4 with the premium, it would be my cost basis of $3.55, which I mean, it would be dirt cheap for Sandstorm. So I made 14%. I'm still collecting my 14%. I'm up like 50% on these put options. So I try to sell put options on stocks that I like, do a little bit more shorter term stuff, buy things over here, sell things over there, buy the S&P, short the S&P. That's what I mainly did in 2022 when we had the trend line. I showed you this chart. We get above the trend line, I short S&P, we go down, buy the S&P. I do a lot of short term stuff. And I think most of us in the stock market, we tend to have a tendency of wanting to trade. We want to sell a position, take profits, do this, do that. We all have this tendency. Now I use my shorter term stuff, which is my cash position, is to get in and out of short-term investments, and this will help me not really touch my long-term investments that I want them to compound over the very long term. So this is the purpose of this 9%, and this is what I mainly do with it. Now in terms of the 1%, I could go back to the whole thing about the narrative about, oh, I'm a growth investor, value investor, and all these things. Well, normally I always keep 1% of my portfolio, or around 2%, 1 to 2% in an unprofitable company. Like absolutely speculative. Like it could go to zero, it could go up 100 times, absolutely speculative. And this is something that people preach against, and you should never do that. This is a very risky investment. But you have to think about it in terms of a risk-reward setup. For example, if you have 1% of your portfolio in an unprofitable company, and this unprofitable company turns out amazingly well, it goes up 10 times or 100 times, you will do amazingly well out of a 1% position. But if this stock goes down 50%, then you lose 0.5% of your portfolio. Now, isn't this an amazing risk-reward setup? You could make up to 10 to 100 times, but you could only lose 0.5% of your portfolio. To me, this is an amazing setup. And this is why I always have one unprofitable stock. The recent one that I had was Hims & Hers Health. It was unprofitable, about to turn profitable. I bought the stock around, I think it was like $6 or $7 per share. I'm up around 150%. The stock is up 169% over the last 6 months. It turned out very well, but I've had stocks before that did not turn out well. The company did not execute, the management did not execute, and I just exited at a loss and I moved on to something else. But I always keep a 1 or 2 unprofitable stocks, 1 to 2% of the portfolio. If they do work out, it could become 2, 3, 4% of the portfolio. Like Hims is like 4% of my portfolio out of like a 2% position, which was a pretty good risk-reward setup. And now, for example, Hims is profitable and I can look for the next one. And this is what I try to do. I always structure the things when I have a limited downside setup, unlimited upside. Once I have this thing, then the fundamentals, they do matter, but they don't matter as much as you believe if you have the risk-reward structured the right way. And it might have been a boring video to a lot of you, but maybe some of you liked it, some of you made it. If you did make it to the end of the video, and if you did learn something, or maybe I gave you a different perspective than other people on YouTube, I would thank you so very much for watching. I hope you got something or you learned something. It was not financial advice, just me sharing my opinion and my strategy. So thank you again. If you did enjoy it, press the like button, consider subscribing, and I'll see you in another video.